We're joined this afternoon with Mr. Andrew Schwartz, the co-founder and Group Managing Director of Qualitas Group. Andrew, thanks for your time this afternoon. Tell us about your firm Qualitas. Started in 2008. What was the impetus to start the firm and what was your background?
So my own background is 35 years of investment banking, funds management experience, and I was fortunate to work through a period of 1980s, 1990s and beyond with large US-based investment banks. The Australian government formed part of my career, and I always had this dream, ambition to effectively start my own firm. So co-founded the firm Qualitas in 2008 in the eye of the financial crisis. I had a lot of people around me saying, Andrew, you sure now's the right time for you to really want to start your own firm? And I actually felt there will never be a better time than in the middle of a financial crisis to start an alternative investment firm such as Qualitas. So that's really the background to the formation.
And tell us about the business. What services do you offer your clients and who are your clients?
Firstly, the only asset class that we really focus on is property. And we're really not trying to be all things to all people. We're very focused on dealing in select markets and select situations. If you look at the areas that we operate in today, you can really break them down into 4 key areas. The first one of those is private credit. The second is opportunistic, special situations, joint venture type situations. The third one is we love the build to rent, the multi-family sector. And the fourth one is we're active in the long WALE type area. So whilst we have quite a few funds, they all neatly fit within those 4 areas in particular. We're 50 people and we've got offices in both Melbourne and Sydney. We tend to hang around the major cities in terms of where we actually deploy our capital. It's important to think of us as a capital allocator, and we really go to great lengths to explain to our clients that we're not a developer. So we're not there to compete with developers. We see developers as our partners, and we're a capital allocation firm to our partners.
And you've been around financial markets for such a long period of time. You would have seen multiple cycles, including the GFC in 2008, which you touched upon. How do you compare the current economic cycle to that of previous cycles that we've been through?
Going back through my career of 35 years, I've been through the 1991 setback, 2008 and now 2020. And by far, I would say 1991 was so far the worst of the 3 that I've personally experienced. We're early in this particular downturn of 2020, so I want to be careful not to make too many assumptions as to exactly how this will all play out. But what I do think, reflecting on it, is this is a very different downturn to those that we've experienced earlier. 1991 in particular was a credit crunch. It was really about foreign banks, over 100 of them that had come into Australia who decided for their own reasons to withdraw from the Australian marketplace. The Australian trading banks themselves, questionable position at the particular time. You didn't have a deep superannuation fund industry. You didn't have sovereign funds, hedge funds, capital funds, core funds, distress funds. And so it was a real credit crunch. And I think 2008 was a liquidity crunch. 2020 is not proving to be a credit or liquidity crunch. It's an event-driven shock to the system that is really affecting the property market in many different ways. So whilst I think that it's a setback that has a long way to play out, I do think it's very different to the other setbacks of the 1991 recession and 2008.
And there's a lot of doom and gloom around at the moment, particularly when looking at Q1 2021. Do you share that view, or are you a little bit more optimistic?
For a recession to be a real recession, people have to reach the point of saying, I don't know how we're going to get out of this, right? The pathway and the exit of the recession is not clear. And if you look at the equity markets, there's a lot of talk about the V-shaped recovery in equity markets. Predominantly that's because people believe that they can see an exit pathway. You know, we need to be on a very heightened level of alert, and there is a lot to be concerned about. You're right at the very moment in terms of the broader picture. You know, property is really based upon a game of confidence, and from my observations, the market is lacking in confidence, and what you tend to find is that it creates a domino effect amongst the various players. So it starts with a story of higher unemployment as a result of the shock to the system, and this is a substantial shock, and a substantial amount of people that are now unemployed. You've got a JobKeeper program, a very large amount of fiscal spend, and the government is doing incredible programs to bridge people to the other side of COVID. But you do have high levels of unemployment. Wages growth will obviously be very low. People are going to be very concerned about their jobs. That affects consumption. People therefore spend less retail, less commitment to mortgages, less commitment to buying of property. The economic cycle starts to slow down. We just saw the GDP numbers come out, first negative number for quite a long time. The Treasurer himself saying, you know, we'll be in a recession, the first recession since 1991, so first recession in 29 years. Economic activity will slow. And so the domino effect has now begun in the property market of lower profits, lower amounts of rent that people can pay, lesser demand by those that buy residential property. And so I think we have to be on heightened alert that this does affect property markets, and we can't think last cycle anymore. There's an adjustment and a recalibration that has now begun in motion. I think being balanced in respect of the other side of that equation is what comes with that is also very low interest rates for a very long period of time. And as I said earlier, there's a lot of liquidity in the market. This is not 1991, right? Because you've got significant players and we're, you know, one of those who have, you know, large amounts of cash ready to be deployed. And so what comes with that liquidity is a tightening of cap rates on asset prices because real interest rates are falling. And so I think there's the tug of war between potentially lower rates of return in terms of cash flow that you earn on property, but to be balanced by tighter cap rates, and it should hopefully provide some level of equilibrium going forward.
And then in terms of the recovery, is there a particular timeline that you would be looking at or forecasting for that recovery within property markets to occur?
Yeah, in the short term, we're in a very challenged environment for really all of the reasons that I said. And I think that everyone, you know, needs to be on somewhat heightened alert in respect to the short term. But I do think in the long term, you know, we live in the luckiest country in the world. You know, we're a large island, we're surrounded by vast ocean, we're able to close our borders almost immediately. You can see the effects of that coming through in lower cases of COVID. It's more controlled compared to, you know, anywhere else in the world. And so I think that Australia will showcase itself to the rest of the world of what a great place it is, what a safe place. And so you overlay that with fantastic laws and transparent legal system, good levels of government, and I think that in the longer term our attractiveness on the global scale only increases. My view is that I think there's going to be 4 stages to how this recovery plays out. The stage that we're currently in, which actually depends on what state of Australia you live in, but in Victoria we're still in a predominantly a lockdown stage. There hasn't been a declaration of an easing of restrictions that allow you to go back to work. But the first stage is the stage we're in at the moment. The second stage will be when you can return to work. I think that will start to stimulate economic activity and consumption again when people more freely move about. The third stage in my mind is the stage of that there's an effective treatment plan for COVID. And I think if that is announced and is successful, then people will feel safe again to go out. You think about your families and, you know, you'd feel safe to take your wife and children out to restaurants and leisure activities because, you know, worst case is there's an effective treatment plan. And I think finally a vaccine would be the fourth. If a vaccine is invented, and I'm like to stay optimistic on these things, but I think that would be, you know, the final catalyst for a recovery. But I think in terms of property, you know, there is a lag effect and things take time. And even if a vaccine was invented and announced and was successful, you know, over the next period of time, I think even post that event, there is still a rebuilding exercise that needs to take place. So I would be saying 18 months to 2 years post that event for us to really go back to what 2019 was all about, if we consider that the normal.
And looking at this, the last 2 months, this COVID period, if you like, how has you and the team managed to navigate through that difficult environment, and have you funded any deals during that period?
COVID came out of nowhere for all of us, you know, so we all had, you know, very significant momentum in our various businesses at the time that it actually occurred. And having worked through two major setbacks previously, you know, our response plan was, firstly, you know, rule number one is let's not lose anybody's money, right? We're heavily invested in the market, and we have a obligation to make sure that all of our investments are safeguarded to the maximum extent possible. So we really prioritise that as a key area for us. And literally went account by account looking at our various investments across the firm in light of COVID and how that may be affecting the position. The second thing we did is we had a number of investments that had been approved by our investment committee at the time but had not yet settled, and for good order we now had material information that was new since we met as an investment committee, and we had a further review of all of those particular investments. And the other thing we did is we looked at you know, the various mandates that we had in the marketplace, and interestingly, like all firms similar to ourselves, when COVID hit, we actually had 7 mandates in the market at the time. And you know, developers and borrowers, being all the good people they are, they like to negotiate every last term and condition until, you know, they've managed to get the best possible deal that they can get, which is absolutely fine and expected. But literally, they all hit our desk at the time that COVID actually occurred, and people just wanted to close on transactions. We did a review of, you know, the various mandates that were out there as well. We've funded 7 transactions since COVID actually hit. We've undertaken 1 refinancing. It's just shy of a couple of $100 million. I think the number's $185 million of transactions since COVID actually hit. So, and in part it goes back to the fact that you know, we're a counter-cyclical business as well.
And what are your thoughts on the term dry powder, and does Qualitas as a business have any at the moment?
So dry powder means, as a fund manager, how much committed capital do you have as a firm that is ready for deployment? So it's under your control, and subject to your investment committee decision, you could actually deploy it. And as a firm, we are just shy of 500 million across all of our various strategies. And so with that 500 million, we also have a further $500 million of expected capital coming back to us as a firm over the next 12 months. So all up, it's $1 billion of capital, and that's within the Qualitas control, and selectively, we'll be looking to deploy it. It does sound like a big number, you sort of go $1 billion of capital. For us, it's actually represents a few deals. It's not as much as you might think, in that, we're not looking to be all things to all people. So, it's probably not as many deals as, the mind imagines when you push the number out there, but we do have $1 billion of dry powder.
And what is the investment appetite for Qualitas as a business at the moment, and where, if anywhere, do you see the opportunities for that investment to go? So
our investment appetite is high, and it hasn't diminished at all as a result of the onset of COVID. Qualitas plays within those 4 bands that I went through earlier in various strategies that range from providing core debt, investment loans to a borrower. We do quite a lot of construction loans outside of the banks. We're one of the largest construction lenders in the country, and all the way through to joint ventures, special situations, and as I said earlier, our long WALE. And so, I can be absolutely objective and agnostic in regards to where we see opportunities, and I'm not in need of needing to push a particular angle because it fits the only product that I've actually got, when you think about the wide spectrum of what it is that Qualitas actually does. And to really properly answer your question, you need to think about what's the strategy behind the question that you're asking. So if your question is, you run a special situation fund, a joint venture, equity fund, do you see significant deal flow, and do you have appetite for that strategy at the moment? And the answer is, we are in a fantastic market for that particular strategy right at the moment. And for us, looking at things that intuitively you might say, why would you want to get involved in a particular sector of the market now, given the various state of the market? For a counter-cyclical special situation investor, these events only come around, a pandemic apparently once every 100 years, so hopefully we'll never see another one again, but a market downturn is once every 10 years, and you could wait another 10 years to invest into a special situation that might only come along every 10 years. So I think that we will continue to see opportunities into those types of areas, and our appetite remains high. I think that for us, we're happy to look at all opportunities. It's really through the lens of why are we looking at it, and what's the expected return, and what are the risks that we're taking in that opportunity, and do we think we're in the right part of the risk return and the right part of the cycle for the actual investment that we're making.
And on the flip side of that, do you see any areas of distress in the market at the moment, and if so, where?
The absolute short answer is no one has walked into the Qualitas office so far and said, I'm in a high level of distress and I need you to resolve a problem in a week. That has not occurred. But I do think the word distress gets thrown around really easily, and people don't really define what it is that they meant by the question itself. And so I think about it in 3 categories. I think about stress, distress, and a market crash. Okay? And I would say stress is, and I spoke to a very close friend and good relationship of the firm the other day, who has very significant investment property and very, very low debt levels. And they said to me that their rental portfolio was some 40% below, what they were collecting last year because they had a lot of hardship tenants in their portfolio. Now, that is an element of stress, right? They're having to really focus more on their actual tenants, but I wouldn't describe that as distress, right? Distress is, and this is not the case with this particular person, distress is, and I've got 70% gearing and the bank wants money back and they want it back in 2 weeks. Okay, then I would say that's distress, right? And then the third part of this is a crash. And a crash is systemic. Everyone's affected by it and it's a wipeout event. And I would say to the broader question, we're definitely seeing elements of stress, and I think everyone is seeing elements of stress at the current point of time. We've not had any isolated incidents of distress so far, and I think the crash, in all probability is unlikely, because an important ingredient of a market crash is that you don't have any liquidity in the market, that it got sucked out of the system. So what happens is you look at property and you say, well, that's incredibly cheap. And it's cheap because no one can buy it because nobody's got any cash. Well, there's a lot of liquidity, and I think that provides a floor to asset pricing and probably makes the concept of a crash difficult.
So the opportunities in the marketplace that you're seeing at the moment, what are they?
If I had to say thematically, where are the themes at the moment that are coming out, it's really in two areas. Developers approaching us for liquidity. There's nothing wrong per se, but they're nervous about next year, and particularly around the first quarter of next year. And so they're feeling two things. One, they want to build cash reserves. They're sitting on a lot of profit that they've earned over the last couple of years in particular, and they want to look at how do we monetize some of those profits so we can build cash, because we don't actually know what's coming. And secondly, if they take a more downside view, then there's going to be amazing opportunities, and they want to make sure they're in a position to be able to respond to those opportunities. So in very recent times, we're getting a push for what I would call more liquidity lines of credit. The other interesting thing that we're seeing, and mainly because we're one of the larger equity allocators in Australia, is developers wanting a more programmatic relationship with Qualitas. So whereas traditionally they would do things on what I call a deal-by-deal basis, they want to agree a sandbox with us that says, if it looks like this, even though I know you still need to look at everything on a deal-by-deal and assess it on its merits, we want to agree the relationship so that programmatically, if there's an incredible opportunity coming our way over the next couple of years, it's all pre-agreed and we can go and execute upon it. I think both of those things are very smart, and certainly we're in with several parties, full flight discussions around both of those.
And what are the pitfalls you see in dealing with non-bank lenders?
On the positive side, we're flexible. I think that we're timely. We tailor solutions to what our clients actually want. We're able to think out of the box in respect of outcomes that developers are trying to achieve. And a good example of that might be, and we're looking at a few of these at the moment, where it's construction financing. And perhaps, it's hard to get pre-sales in this market at the moment, for all the reasons that I said earlier around confidence levels by purchasers, but also purchasers wanting to see a building actually start before they're going to commit to it and put a deposit down. And so, but the building can't start unless you get finance, and rightly so, the major trading banks have a relatively tight credit box around the amount of pre-sales they require. Now, because we're also in an equity business ourselves and we do nothing else but property, and we're deep dive, we're able to look at the project on its fundamentals and say, based on our view of that project, do we think it will be successful? And if the answer to that is yes, then we will consider it on a lower level of pre-sales than perhaps what one of the major trading banks will be. So I think it's really about that type of flexibility as a solution that we bring to the table. on the flip side, and this is me trying to be objective, is our pricing's not the same as a trading bank. We don't fund ourselves, the same way that a trading bank funds themselves. That's a consideration for developers in terms of, dealing with groups like ours. I do think that, a lot of the developer community, particularly the more seasoned developers, have grown up in an environment where they see money as being relatively homogenous. And so if you go to one of the trading banks, then you basically view all the trading banks the same. Maybe the only point of difference is the actual person you deal with and your relationship and trust in the person. But I think that this is a general statement. It's not about necessarily Qualitas or anybody else. But I think in choosing a non-bank lender to deal with, a borrower really needs to go into a mutual due diligence. So just as a lender due diligence as a borrower, I think the reverse needs to occur as well. And there's some really fundamental questions that I think a borrower needs to ask its lender. And some of those questions, when I say them, they'll sound obvious, but rarely do you actually ever get asked these questions. But those questions are, who owns the money that you're actually giving to me as a loan? Who's the owner of it? The second question is, who controls the money? If I have a problem with this particular loan, who makes the decision as to forbearance or waivers? Or do you have to go to another group of people to actually seek any changes to various loan conditions? And also due diligence, what the sector experience of the party is that you're dealing with. And I think that there's money that's available from a large amount of places. It can be local institutionalised non-bank lenders. It can be private families. It can be offshore lenders that have multiple areas of focus, and Australia is only but one of them. Understanding whether your loan sits in a portfolio of loans or is it a single asset loan that's been syndicated out to private high net worth investors in the background. These are really important questions. And I guess I'm continually surprised that developers and borrowers don't ask. And I guess, one of the bits of advice I would say is I think they're good questions for borrowers to ask back of their lender. In the case of Qualitas, we've worked hard to have discretionary capital, and we've said no to a lot of capital that has wanted to side with us that was not of the form of discretionary capital. Discretionary meaning we make the decisions over the capital. There's no greater party that we have to rush to for them to make the decisions. And so we've spent a lot of time looking for discretionary capital, searching the globe for it. Half to 2/3 of our capital actually is raised outside of Australia and is in the form of fully discretionary capital to Qualitas, and it's cost-efficient capital as well. So I think they're the benefits that groups like ours can pass on to the clients, but I think equally it's really important that clients, borrowers ask those questions to really make sure they've understood where this money has come from.
And what's been your experience with the Qualitas Real Estate Investment Fund as compared with more traditional investment structures?
Qualitas doesn't have contributory mortgage funds. Where our investment structure really fits into mainly the vast majority of our investments are closed-ended vehicles. So closed-ended meaning you have a certain amount of investment period and then you have a maturity period, and as and when the loans or the equity investments mature, you pay out those proceeds to the investors pro rata to their participation. And that really summarises the absolute vast majority of our business. We've got one fund that's an open-ended fund where investors can redeem, but the redemptions are relatively limited periods of time. The listed income fund for us is a fantastic model. It's one that I'm very wedded to. I think that if you look at the reason why we established it is we felt that there's a place on the ASX for investors to get monthly and reliable income, and with a focus on capital preservation. And how better to do it than do it through mortgages, where you get monthly interest and you've got a mortgage. And so it delivers on both objectives of income and capital preservation. The other reason why I really like it is because where a lot of these models can sometimes become a little bit unstuck is you have a mismatch between your asset and your liability. So your asset is the loan that you made to a borrower, and the liability is back to the owner of the money. And so what you're able to do through a listed vehicle is the capital is permanent. And so if somebody wants to get out, they want to redeem, they don't need to ask you, the manager, to sell a loan to get their proceeds back. They just sell their shares. And so you've overcome that asset liability mismatch. We have no debt in our vehicle. We are the debt. We provide that to the borrowers. And so it's a through the cycle vehicle. And I think, history is littered with examples of finance firms that didn't make it through the cycle purely because they had asset and liability mismatch. And that's something that thankfully through our listed vehicle, Qualitas Real Estate Income Fund, that we don't need to contend with, and it's a very stable vehicle for that reason.
And what asset classes, if any, at the moment are you and the team avoiding?
Now, as I said earlier, we're not really seeking to avoid anything. Your question is what I think it might be, what asset classes do I think are more challenged at the moment, potentially, is your question. And if that's the question, I'd say hotels or leisure, education, property where the income is directly affected by the advent of COVID is clearly areas that is going to be difficult in the short term. But a lot of our strategies are counter-cyclical. And so from our point of view, again, coming back to risk and return pricing, I think we're open to looking at all opportunity. It's for us really a question of why are we looking at it, as I said earlier, and is it right for the strategy that we're actually looking at? One
of the things you mentioned earlier is the build-to-rent sector. Everyone's got a view on it. Some are supportive, some are critical of it. What's your view on it? Where do you think it's going? So we're really positive on the build-to-rent sector, and again, I think in the short term you can understand the views that others have expressed around some of the challenges, which I won't necessarily go through. But the reason we really like it is because in the past what would happen is you'd have commercial cap rates and residential cap rates, and there was a fair gap between them. And the market is recalibrating at the moment. And it's recalibrating in a way where all of a sudden the darling of the market, being office, is no longer considered such a darling anymore. And so investors are wising up to really looking at what's the underlying strength of the revenue that is supporting the property itself, and what's the cap rate of the property. And what you have found is that as interest rates have kept coming down and there's more liquidity pushing into the market, the cap rates across the whole sector have actually reduced. And as they've reduced and residential has held relatively firm, all of a sudden residential cap rates and other cap rates are of relatively equal keel. And the net effect is astute investors are able to say that one of the benefits that come out of build to rent is I don't have one tenant as you do in an office type building. I've actually got a multitude of tenants, and I've got diversification, and I've got risk mitigation in respect of my revenue. And so I think those two points combined start to make it an institutional asset class. And as soon as it becomes institutional, you have capital that's looking to deploy and really grow into that industry. And so that's not my way of ignoring the challenges around the cost side of this in terms of some of the tax imposts in respect of
build to rent, which has been well noted in the media. But I do think often the revenue side and the security of the revenue gets ignored in this argument, and the future outlook on cap rates, and that's why I'm a big believer that this asset class will exist.
And a lot of your investors, as you said earlier, do come from overseas. When you've been speaking with them, how do they see Australia into the future? Do they see it as a positive destination for investment and capital allocation just because of the way things have been handled here over the past couple of months and the underlying fundamentals as a country?
Hugely. So I do spend a lot of my time overseas with investors, large institutional investors, admittedly not over the last 3 or 4 months. I've been very safe and sound in Melbourne. But what you find is that Australia really sits on its own in terms of the competitive landscape for capital. So if you're in Europe, you've been sitting in an environment of negative interest rates, benign economies, not just since COVID, but for the last decade. Substantial geopolitical type risks amongst various countries, and somebody like me comes along and talks about Australia in terms of growing population, high levels of immigration. Our immigration in the past, and immigration's a whole other topic given where COVID is and our borders are closed. But if you really think about immigration, Australia's immigration is skilled immigration. It's not refugee, migrant immigration in the main. It's skilled. It's people that have come here for jobs. They've needed houses, schools, public transport, and they've really stimulated the economy overall. So Australia's had all these very natural growth drivers overlaid with great legal system, fantastic government that has had policies that have really, further driven economic activity. A wonderful central bank that has used monetary policy in the right sort of way. So if you're an investor overseas and you're looking for non-correlated investment risk, then you'll be thinking about Australia because of all the benefits that it offers relative to other places of the world. And I do think that with the onset of COVID and looking at what's happening in the United States at the moment, which is absolutely heartbreaking, and the ongoing geopolitical issues of places like Europe, that Australia just continues to look better and better if you're sitting offshore. So I think that'll continue, and I'm not personally concerned about the medium term in respect of capital flows.
If there are developers out there watching this that are tossing up between different sources of lending, what do you think is the point of difference that Qualitas offers that perhaps your competitors don't?
So I think that Qualitas I would say we've got 2 prime advantages. The first of those is we are only property. We're not trying to be all things to all people. And so that gives us a huge competitive advantage because it's an asset class that we understand at the deepest of levels. And the second major advantage for us is our discretionary capital, that we are dealing with money that we control. And so I think that that really gives us the confidence to speak for the capital. And if we say we're going to do something, then we do it. And that's a very large competitive advantage. Now, having said that, I do think it's a wonderful industry in Australia, and that certainly is not my way of saying necessarily we're better and the other competitors in the market are less so. That's not my view. I think it's a really strong industry in Australia. It's institutionalised with good practices and protocols, and I really do want to emphasise that point.
One final one, and we spoke about doom and gloom earlier. A lot of people are sick of the media, the mainstream media these days, putting out negative articles about the property market and anything and everything to do with property. Where do you and the team go for trusted sources of information to really assist your decision making?
Everywhere. So when we're due diligencing specific situation, we're really trying to get as much information as we can from as many people as we can. Now, obviously doing that in a way that protects the privacy of the situation that we're dealing with. You know, thankfully I've got a great group of colleagues around me. We tend to hire people who are in their second and third careers, and they themselves have very deep sector knowledge. We triangulate information, so you know, we look to try and confirm it in as many different ways as we can. We're not a check the box, tick the box outfit, and so, you know, and I'm not saying that's not a formula that doesn't work or is not right for others, but it's not our formula. And so for us, we look at a project on its fundamentals. Yes, we go and get a valuation, but the valuation for us might just check the assumptions or our thinking about it. It's not our primary driver of making a decision in a firm like a Qualitas. So I think it's wide. You know, I've got a fantastic board around me, and you know, they themselves have, you know, very deep sector knowledge, and so we're able to really bring in, you know, a lot of information from different places to make sure we land in the right spot. Now, you know, thankfully, we're you know, more than 150 investments into the establishment of Qualitas, and you know, I don't say this lightly, but thankfully, you know, none of our investors have lost any money in any investment that they've invested with in respect of our firm, which, you know, means, you know, every investment we've done has proved up on the other side. Now, that doesn't mean you can't lose money. It doesn't mean it's not a guarantee that we'll never lose money. We're in a risk business, so obviously, you know, what comes with that is the potential to lose money, but we haven't so far. And that's really because we heavily due diligence a situation that we're involved in, and we make sure that, you know, we can make sense out of it, and it has to be right for us in every way for us to invest. And so far it's worked for us pretty well.
And finally, what's next for the Qualitas business?
Well, I think just stay, you know, COVID's interesting in that I think if it's done anything, it's probably narrowed our ambitions, right? Because you can't be all things to all people. And so our ability to be mobile and, you know, look at expansion of geographic regions, or, you know, lots of other things that, you know, could be on our agenda. We just want to go deeper in what we're doing at the moment, and both on our partner relationships, so our developers and joint venture partners, just go more with our trusted partners and go deeper with our investors. And I think that's a really simple recipe for us for the next little while.
Well, Andrew Schwartz, thanks so much for your time this afternoon. It's been a pleasure.